What is the minimum cash flow that I need to buy a deal? So let me explain two quick concepts real fast. So there is cash flow, which is your monthly profit that you're anticipating on a property. So you're like the rental income minus the expenses, minus the money you're setting aside for reserves, which include vacancies, maintenance, all that kind of stuff. So your cash flow is the profit. Income minus expenses minus reserves is your cash flow. That number, if it's a long-term rental, most people are willing to buy long-term rentals that generate at least $100 a month of cash flow. For me, deals at that low of cash flow no longer make sense, but it's hard to get much more than that unless you are doing something like a short-term rental, a mid-term rental, or co-living, my favorite of all those management strategies. So for me, for my co-living rentals, I don't buy a single property that generates less than $1,000 a month of cash flow. And then a big part of that is not only is it not worth my time to do all this work for $100 a month, but if I'm raising money to buy these deals and I'm paying a private money lender a fixed interest rate, or a private money partner splitting the ownership with them, including the cash flow, well, if it's less than $1,000, what are we really splitting? If it's $200, $300, what are we each doing all this work and them investing to then split $150? Like, that doesn't make a lot of sense. So my criteria personally is I do not do deals that generate less than $1,000 a month of cash flow. Big reason for that is it's really not worth my time to do anything less than that. And secondarily, if I'm raising the money, which I always do on my deals, well, I've got to pay a private money lender or split some of that with a private money partner. If it's less than $1,000, there's not enough meat on the bones, in my opinion, to then make the deal worthwhile. Depending on where you're at in your investing journey, you might have a different cash flow goal. I said all that for cash flow, but cash flow cannot be put in a silo. Cash flow needs to be complemented by another metric called cash on cash return, which cash on cash return is what is your annual cash flow, right? If you make $1,000 a month or $12,000 annual cash flow, right? 1,000 times 12 for the year. You have to divide that by your entry costs, how much money you have to put into the deal to acquire it, renovate it, furnish it, reserves, whatever. You have to take your annual cash flow and divide it by the entry cost, what it costs to get into the deal and get your property operational. You have to account for that. Otherwise, the cash flow in a silo, like in a vacuum, doesn't mean a lot. Because if I put in $100,000 to buy a deal, or I put in $10,000, or I put $1 million to get $12,000 a year of cash flow, that makes a huge difference. I don't know what those numbers are specifically, but that is why the cash on cash return, your annual cash flow divided by your entry cost, is so important to understand. That metric is so massive. And I would say that is a better metric for most people. Like I said, cash flow, you have to understand your cash flow metrics. You have to understand your cash on cash return. What are the minimums that you're willing to do? Because cash flow, there needs to be enough meat on the bones to make it worthwhile for everyone involved. But then you need to understand your cash on cash return. So then you understand, how hard is the money working for me that I'm investing? If I'm investing $10,000 versus $100,000 versus $1 million to generate that $12,000 of annual cash flow, you need to understand the less you put in to get the higher cash flow, the harder your money is working for you. That's very imperative. I can actually show you that. And then I will show you my specific different requirements for long-term, mid-term, short-term, and co-living. And I'm almost exclusively only doing co-living deals now because those just make the most sense logically. It's just an integral part of my super investor blueprint. So let me show you that. And then I will actually be able to touch base on some of the other questions that were asked. So let me screen share. So when you look at my requirements, this is the Super Investor Creative Finance Calculator. So this is a paid calculator that is exclusively offered to my super investors. You join, you get lifetime access to this calculator. I have a free version of this calculator in the Wealth the Real Estate community. You're more than welcome to download it. It is not nearly as robust as this one, but it's negotiation information. It doesn't have long-term analysis, or if you're raising money, like what, spit all this stuff out. If you're raising money from a PML or a PMP, like you put this in your presentations. It doesn't have all of those automations, especially the capital raising piece, but it's a great calculator to be able to analyze deals. It's actually the number one calculator. Me and one of my mentors, Jerry Norton, are quite literally fighting for that number one spot of like best free calculators when you Google them. All right. So with all that being said, you can go grab a free copy of the calculator in Wealth the Real Estate, or if you're interested in being a super investor, reach out to me directly. We'll see if you're a good fit for it. And then you'll get lifetime access to this calculator and all the updates that I provide, which we're doing a huge new revamp coming up soon. So minimum cash flow that I need to buy. So for a long-term rental, my minimum requirements are $100 a month and 10% cash on cash return. However, for the most part, that doesn't make sense for me nonetheless. So you have to be realistic. If your goal is like 50% cash on cash return, well, you're more than likely not ever going to find that creative, traditional, whatever for a long-term rental, unless you're buying a property that has really ridiculous rent. Well, that's not really possible. There's only a limit to how much the rent can be. Has like really, really low, like it's a really cheap property worth very little. And then the monthly payments are very low. That's really the big arbitrage you're going to do there. And I don't want to own a portfolio of $50,000 properties that generate me $500 a month as long-term rentals. Like I don't want to do that when I can buy bigger, better properties in nicer locations that generate me higher cash flow, generate me better ownership benefits, better tax benefits, better debt pay down. There's more of these available, and there's are easier, bigger markets. Like for me to get a contractor in Atlanta is much easier than some small freaking town on the outskirts of, I don't know, I don't even know, just tiny little markets. And that's where co-living allows me to do kind of get the best of both worlds. I'm able to get much higher cash flow as a co-living rental, and my cash on cash return is higher, which means that I can also raise money more easily through capital partners. So basically, the higher your cash flow and the higher your cash on cash return, the better your deal is, the more people want to either fund you, they feel more confident in you if they're lending to you as a private money lender, or as a private money partner. When you split those ownership benefits, it makes more sense for them. So my pad split or co-living cash flow that I look for is at least $1,000 a month. And the cash on cash return that I look for is at least 15% cash on cash return. I have the same requirements for midterm rentals and short-term rentals. I have a cash flow goal of $1,000, but I want a higher cash on cash return because I think it's more risk. The more risk, the higher the returns you want. That's why for a long-term rental, I'm willing to do a 10% cash on cash return. However, for a co-living, which I think is more risky than a long-term rental, I think everyone would agree with that. However, there's much more benefits overall. So I want much higher cash flow, and I want much higher cash on cash return of 15% here to move forward with a co-living rental. This number fluctuates. I would say honestly, it's between 10 to 15%. As long as I'm hitting my cash flow goal of over $1,000 a month, and it's still a solid deal in regards to cash flow, but then has really great ownership benefits as well. That's really what I'm looking for. When you're talking about ownership of great properties, you're not just talking about the cash flow. A lot of people get hyper focused on just the cash flow, and that is imperative, right? If you have a private money lender, you need cash flow to be able to pay that private money lender their interest. Or if you have a private money partner, yes, they're going to want cash flow in exchange for the money they're investing. They want some of that money back in terms of cash flow. But if you are buying these properties, you're owning them, and you're bringing in a private money partner, not only do they get, for this, they're putting in $89,000, almost $90,000. And in this instance, let's say it's a 50-50 split. They're not only getting 50% of the cash flow, they're also getting 50% of the ownership. So not only are they getting for this $89,000, and they're splitting the, right? So the total cash flow on this property is $19,895. Well, they're getting their 50% of that. They're getting $9,947 of cash flow, giving them an 11.1% cash on cash return. Not only are they getting that, but as an owner with you, they also get the benefit of the debt. You guys are paying down the debt, which is adding to your equity. They get a benefit of that. Your properties are appreciating in value. As an owner, they get the benefits of that. As a 50% owner, they get 50% of those benefits. The tax benefits, well, you're paying interest and your properties get depreciation. Those are tax benefits that they also get ownership benefits to. So when you look at the total return on this investment, it's not just the $9,000 of cash flow they're getting for the year, $9,947 of cash flow, or the 11.1% cash on cash return. Well, they're also an owner. They get ownership benefits. So their total return on investment is 23.1% ROI, right? And in my opinion, that's a really freaking high ROI and a high cash on cash return. Depending on where you're at in your investing journey, you might need to offer that 50-50 split for someone to partner with you and fund that deal. For me, my partners get because the more proven an operator you are, the more you pay people out, the more you take care of your partners, the longer you've been doing it, the more knowledgeable you are on these deal analysis, structuring, operations, the less you can offer and still have people partner with you because you are a more proven operator. You're a lower risk to them. Not only is the deal better, but you're also a lower risk to them. And so maybe it would be a 40% split, whatever the actual split ends up being. And they're getting a slightly lower cash on cash return and return on investment. Honestly, these are solid. Still almost 9% cash on cash return, 18.5% return on investment. They get 40% ownership of the property, because this deal is a great deal overall from both and these are fake numbers, right? I don't know anything about this deal, but the cash on cash return is so high, the cash flow is so high, and the ownership benefits of this property are so high, they're getting a massive overall return on this. So when you ask me, what is the minimum amount of cash flow I need to buy a deal? It depends on the management strategy. For long-term rentals, it needs to be over $100, but honestly, anything under, like if I'm not taking home at least $500 per month per property, it doesn't really make a lot of sense for me unless there's a phenomenal ownership benefit side, like that multi-million dollar property in San Diego, I get little to no cash flow because I was able to get into it for very little money, virtually nothing. I have almost infinite returns. And because it's such a big, beautiful property that is in a great market, I get tons of wealth benefits. So even if I only make $1,000 for the year in cash flow, I'm making 50 plus $1,000 a year in ownership benefits. So it really depends on the deal and what you're looking for. But for depending on your minimum cash flow requirement is going to depend on the strategy that you implement. Like I said, for me, I don't want any less than $500 a month of cash flow, regardless of the strategy. And that's after paying my capital partners. So to make sure that's possible, I need to make sure that my properties, especially co-living or pad split, the main thing that I do is at least $1,000 cash flow. And then my cash on cash return needs to be at least 10% or higher. So my partners are also getting great returns for the money that they're investing. The higher cash on cash return, the harder your money is working for you. Whatever you guys invest into the deal, that means you're getting a larger return in regards to cash flow. When you now combine that with ownership benefits, right, then it's even better returns for your partners and for you as well. So what I mean to say is cash flow is important and it's going to depend on your management strategy. Your cash on cash return is very important because it talks about how hard is the money you guys have invested, how hard is it working for you, how much annual cash flow are you getting relative to the entry cost they had to put in to get into the deal. But then there's also the ownership benefits, which is part of the total return on investment that I think also needs to be accounted for, because real estate is not just a cash flow game. You're also getting the benefits of ownership. That's why it's so imperative to understand how to analyze deals, both as the buyer, the lender. I mean, I think wholesalers should do it as well, but I don't think the majority of wholesalers are getting this nitty gritty with their analysis. If they did, they might sell more deals because they could articulate it better, but that's not my job. All right, with that being said, depends on your management strategy. I explained the variety of cash flow goals and why cash flow is in a silo does not matter, because whether if I'm getting $1,000 a month or $12,000 for the year, it depends. If I have to put in 10,000, 100,000, or $1 million to get that, that's your cash on cash return. It's telling you how much are you getting in return to the money you had to invest. So that's really important. Not just cash flow, but also your cash on cash return. And then it's important to understand also the ownership benefits involved with real estate investing, not just the cash flow.